I'm Pablo Casalimas, and you are tuning in to the 161 Report, streaming to you live from Bamboo Strategic Media. The 161 Report is a show brought to you to help entrepreneurs succeed by bringing you interviews with successful entrepreneurs, investors, and industry experts. Today, we have The Secrets of Wall Street, brought to you by Alex Lualdi, CEO of Hudson Metrics. Hudson Metrics takes a systematic approach to creating trading models that they use across the world in the stock markets of Japan, the United States, Europe, and many places across the world. So it's our pleasure to be here with Alex. Alex, thank you so much for being with us today. It's a pleasure. I heard a little bit about your story, and I'm super excited to learn more. Thank you.
Thank you, Pablo, for having me in your program. It's a great pleasure to talk about my experience in the financial markets with you.
Absolutely. So why don't you start by telling our viewers a little bit about your backstory? I thought it was quite a fascinating story, how you ended up in this world. Why don't you get started by sharing that with us?
Well, see, Pablo, I've always been interested in the financial markets since when I was very young. When I was learning from my grandfather about investing long term in the markets and discussing every day with him about it and learning everything I could from him. And as soon as I graduated, the first thing I tried to do in Italy, since I'm from Italy, was to get a job in finance. But back then, the financial industry in Italy wasn't that very well developed, and I couldn't find a job that would satisfy me. So I decided to take a job elsewhere outside of the financial industry, and that job brought me to New York. That job brought me to New York in the fashion industry, actually, which is totally unrelated to my background and to what I studied for. But it was something that, first of all, gave me the opportunity to go to New York, which I've always dreamt about. And second of all, it put me in contact with the Wall Street part of New York in particular, since I decided to live in Wall Street. I actually rented an apartment that costed probably half of my salary back then. And in Wall Street, 63 Wall Street, which is the Crest building in Wall Street. And from there, I met people working in the industry. I met in particular this one guy working for a very large hedge fund that was actually my neighbor. And he taught me a little bit about trading, quantitative trading, sorry. And I fell in love with it. I started building my own very simple mathematical models applied to finance. And then these models over time developed and developed till I felt comfortable enough to go full time in trading with my own capital.
Now, when you made that decision, did you feel like you were ready? Did you feel like you had the experience to just live off trading or get into this field completely?
I think I was young and dumb, and I was crazy enough to believe in myself. I don't think I was ready looking back. In fact, in the first few years, I didn't make money. If anything, I lost money. It was a really tough way up. But I have to say, to be honest, I don't regret it, even if it was that tough, even if the first few years of my trading career, I had to go through a lot of margin calls and a lot of problems and a lot of, not making enough money at the end of the year. But it's all part of the process, I guess. What was the crazy part is that I had a job, and which was a good job, and the only issue is that it wouldn't be my ideal path to success in life. And so that was a little bit crazy if I look back, to leave everything behind and decide to go in trading with my own capital, because that was my decision from the beginning. Do it with my own capital, not outsource capital. First of all, because I wasn't feeling ready enough to take money from someone else. Second of all, because I realized over the time that my job is not managing other people's money, but my own capital only. And again, not easy to do it this way. It's, as they say in the industry, it's easier to do it with someone else's money. For me, it's the opposite. It's easier to do it with my own capital than to do it with someone else's capital. Because if I were to invest for you with your money, I couldn't perform as well as I perform with my own capital. And that is a little bit of a limit for me and for my career, because, you know, I could be an hedge funder, but I have that limit.
Right. You mentioned that in your first 4 years, it was very tough. You were losing money a lot. I guess, were you still in New York during that time?
I was between New York and Miami, and I was going from New York to Miami. I was also getting married. It was, I want to say that the toughest years were the first 2 years, and then the third and fourth probably were years where I was making around, I think the third year, $12,000 at the end of the year. And then fourth year, I think it was the year where I started actually making it, and was the year where I went from an account of 5,000 at the beginning of the year to 50,000 at the end of the year. So that's a very big amount of money to be making with 5,000 only. Not a big amount of money, but a big percentage at the end of the year, big performance. And that was the year where I said to myself, okay, I can do it. I can do this. I can actually live off trading. I can career out of it, and was right.
Yeah, and in those first couple of years, you know, that must be very tough to go a whole year, not only that, a whole 2 years of losing money. What kept you going during those times? Did you ever think, like, maybe trading's not for me?
So many times, so many times. I cannot count them. I was lucky on one thing. I never had a gambling mentality, a gambling approach to it, and I never had a crazy risk side to me, to my approach to trading. So even if I was losing, I wasn't losing big amounts. Okay, I was living off savings, and so it was very important to me to, yes, risk it, do it, but do it with limited risk. So that's what not only saved me in the years where I was losing money, but also taught me to do it with an approach to risk that is, first of all, limit drawdowns, which is a measure of volatility on your equity line, a measure that tells you the size between a peak and a valley in your equity line. So it's a very important number to keep in control. So I've always tried to develop an equity line with a very limited drawdown.
And this line that you're talking about, for our viewers who don't understand the terminology as much, what you're saying is these are limits that are set so that if the stock goes below this price, then you automatically sell. Is that what you're talking about?
No, that would be the stop loss.
Right.
Drawdown is more, imagine reaching the equity line is your performance. Okay, imagine reaching a peak in your performance. So, for example, you're up 40% for the year. Now you start taking some losses and you go down to plus 35. That measure, roughly, just to be simple, is around 5%. So from 40 to 35, it's a 5% down. That is called drawdown, and it's the temporary distance or spread between a peak and a valley in your performance, in your equity line.
Right. And by doing that, you were able to limit your risks to how
Right.
much you would lose per year.
by working on that number in particular with my models and with my systems, and also with keeping in control what I would do day by day, I was able to, by limiting that number, I was able to limit the volatility on the equity line and therefore the risk on the equity line. So yes, I was not making money, but at the end of the year, I wasn't like losing it all. Okay. Also, because when I talk about margin calls, I was probably keeping a little bit of the total capital in an account, trade it, maybe lose it, but then I would have the whole account safe in a bank account. So not all with a broker. So I could experiment a little bit with the models. I could experiment with my capabilities and with my development over the first few years without risking all of the money that I had decided to put in the market.
Right, that makes sense. And at what point did you move from New York and Miami? Did you spend a lot of time between those places, or?
Yes, because the learning curve and the learning process was very long, as you can imagine. For me, doing it by myself with my own capital, and in New York, I had a lot of friends who were working in Wall Street. And so even when I moved to Miami, I was going back and forth to work with them and learn from them. And that was what gave me the keys to what I'm doing today. And also by developing my own niche, very small niche, which is market timing, I was able to keep in touch with the New York, Wall Street friends, and that gave me the opportunity to advise for some of them. So before I learned from them, and then I developed models that became solid and good enough for me to actually be able to advise for these friends that were working in Wall Street.
Wow, that's fascinating. So first you spent a couple of rough years losing money, going through difficulties, and all of a sudden you flip the script and now you're coaching the people who had coached you. That is actually phenomenal.
That is amazing, yes. And I always laugh about it with them because, if I think about where I come from, which, it's very far from Wall Street. I come from a very small town outside of Milan, Italy, and where there's no big culture around finance, in particular about market timing. It's a very old style finance in Italy. Maybe now it's changing a little bit, but back then it was pretty much old style. And now, I don't know, probably it's changing.
Yeah, okay. Well, we're going to go into our first commercial break. We've got a very special message for our viewers from Colin Austin. And this is a placement that he won last week by sharing our episode and hosting a watch party. So if you're tuning in and you host a watch party, you have a chance to win a free ad placement on our show during next week's episode. So make sure you do that. We'll be right back.
Hello, everybody, and welcome to another episode of the WHOA G&D podcast, the podcast bringing you businesses and individuals that make you go, whoa. Hey guys, Colin Austin here, co-host of the WHOA G&D podcast, coming to you from right here in Gainesville, Florida, baby. First and foremost, thank you for supporting my friends at the 161 Group. Like 161, we have a very similar vision in building up Gainesville. I'm so blessed to be able to call these guys my friends. So thank you so much for supporting them. If you love 161 Group, then I would encourage you to check out our WHOA GNB podcast. For over 2 years, we've been bringing you deep and inspiring stories from people all over with a centralized focus of the businesses and individuals right here in hometown GNB, baby. We've shared stories from business owners, sports figures, first responders, public figures, influencers, authors, children, and so many more. I'd be honored if you'd visit us at whoagnv.com or search for the WHOA GNV podcast on your favorite podcasting platform. And we're bringing you new episodes every single week, and we've done it for 2 years without fail. So be sure to check them out. You can find us. You can also find the video version at whoagnv.tv or on Facebook, our Facebook page, which is just WHOA GNV podcast. I love you, Gainesville. Thank you for supporting our entrepreneurial community. Stay strong, and I just look forward to what the future holds for our awesome community. This is the WHOA GNV podcast, the podcast bringing you businesses and individuals that make you go, whoa. We will see you later. Bye.
Welcome back to the 161 Report. Thank you for tuning in. We're here with Alex Lualdi, and he just finished telling us about his time on Wall Street, what he learned, and some of the challenges that he faced, as well as how he actually flipped the script, moved to Miami, and started teaching some of the people who helped mentor him when he had just gotten into trading. So, Alex, I would really like to get into some of the lessons that you learned in those first couple of years and how that shaped your thinking and your investment philosophy.
The best lessons that I've learned are lessons from the market directly, from losing money, I guess, but also from making money. You know, I like the learning from failing thing, but I prefer the learning from actually making it, actually succeed. I think you can learn a lot from successful experiences more than from painful experiences, especially because I tend to forget the painful ones pretty fast and focus on the positive and good ones. But I remember in the beginning of my career taking one or two trades bigger than I should have, and one or two losses bigger than I should have. So that taught me risk management. But if I have to say about one of the secrets that I stole from my experience on Wall Street and with people, from the people that I met there, is that you cannot trade or invest in the long term without a quantitative approach. Especially today, it's very complicated for anybody, unless you are Warren Buffett, to trade without a quantitative approach. By that I mean that the buy and hold strategy that my grandfather taught me and was applying many years ago, in the, probably I remember in the 90s, it's no longer a safe strategy because, yes, of course, in 2012, if you were lucky, you would buy a few stocks and then you would hold it and you would be rich right now. But it's not easy with the current volatility, with the current market going up and down in pretty great swings. Look at the recent history, look at oil, look at the S&P 500, look at anything that went down in March and April, and now it's gone all the way back up. It's a scary market. So to think that there are people doing what my grandfather was doing 40, 50 years ago, where it was, buying stocks of big Italian companies and holding the stocks and letting them run for a few years and then cash out. I mean, it's difficult. It's complicated today because volatility is bigger. We have computers doing things that weren't doing before. We have algorithms like mine continuously playing in the market, putting in volume and volume and volume. So it gets complicated, frustrating sometimes to see the markets moving so fast and so much. If you look at the move on oil, for example, You could be an investor, a long-term investor on oil, and have bought at 30 and have it at 60, and then in a few days you see it go from 60 to zero, and then from 0 to minus 40, I guess it went in a few minutes. So it's a crazy market. It's a wild market, and you need to have a quantitative approach in order for you to be safe. That doesn't mean that you're gonna make money all of the times. That doesn't mean that you're gonna make money anyway. But it means that with a quantitative approach, there are more chances for you to, first of all, be safe. First of all, avoid some problems. And second of all, have a greater chance of making money in the markets.
Right. So you say the top secret you learned on Wall Street is you have to take a quantitative approach. Now, what is the first step to creating a quantitative approach? Can your day-to-day person do this, or is this something that you've got to be an expert level trader to do?
It's a good question. Thank you, Pablo. But the answer is not going to be very good as well, because it's very difficult to answer, actually, because there's many resources out there today in the quantitative arena, and it's a good positive thing, but at the same time it's a bad thing. With the great offer comes also, or the wide offer comes also a great difficulty in spotting good things from bad things, good services from bad services. I guess the do-it-yourself thing is long, complicated. I'm an example. It took me 10 years to develop something good in quality and safe and making money. So for the average investor to be developing his own algorithms to read the market in a quantitative way, it's kind of complicated. First of all, you need to have a background in mathematics. And second of all, you need to know what you're doing in the markets. Trading is a little bit like flying. So you need a lot of flying hours in order for you to have an experience that makes you a good pilot. The same thing for trading. You need to have thousands and thousands of trades in order for you to consider yourself a good trader. Imagine that for myself, I'm an high frequency trader, so I have days where I do 40 to 60 trades. This year only, I think I've done around 5,000 trades. Okay.
Wow.
So it takes a long time to reach the point where you can do this. The good alternative is to learn from someone that has been doing it for years. For example, we do it. We teach both institutional and retail investors. We have a program right now which is called fearless.money. It's actually a website which is fearless.money, and we do it. We do it with any kind of investors, in particular high net worth investors. And we provide the software that I developed, the quantitative software that I've developed, and then full-time training. And we actually have been doing it for years now. And we have traders that have been trading with us for 3-4 years, and we're still training them. I say we, because I have a partner in Miami who's helping me, and Martinez, the training and the development of the systems too. And it's cool. It's a fun business for me because it put me in contact with people. Otherwise, my whole day would be being in front of monitors, trading, and then I wouldn't talk to anybody. So it tends to be kind of boring. Boring, I don't know, because it's kind of hectic, but it's you're too close in your trading room by yourself, so it becomes a little bit weird. So having these training program to run, first of all, is great business for us. Second of all, is also something fun, something motivating, something where we have this group of traders growing, and they're very motivated, very enthusiastic about the system, about the strategy, about growing as traders. So it's pretty cool.
Yeah, and you said that you personally do around 40 to 60 trades a day. You're not doing these manually, are you?
Yes, I am.
Really?
So yes, so I have my algorithms actually popping a message on the screen saying, okay, we got this is the direction, we got a trade in that direction, which is the most the important direction right now for the institutional traders. So it's based on volume and it's based on price. So when you mix these two things, it's really difficult to go wrong in the markets because you have an information that tells you exactly what most of the institutional people are doing. And you just do that, you just go in that direction. And then the other algorithm that I developed tells you exactly which price you're gonna have a bounce in that specific direction. The reason why I don't do it fully automated, 100% automated, is because I believe more in the human mind than the computer ability to process 360 the information that it has to process. So I'm able to get the information, the quantitative information from my system, and then apply it to the market. And I might stay in the trades for 1 to 3 minutes, and then out, and then again 1 to 3 minutes out and back again. And this is 95% of my trading operation. And it's great because I call it high frequency, even if it's slightly different than high frequency. It's more intraday, very quick intraday. And it's cool because, you know, at the end of the day, I don't have any positions open, okay? And I can sleep nice and easy. If I have positions open, then it's kind of different because I tend to think a lot about the positions that I've opened, especially if they're not doing well. And I'm not a good position trader. So if I take a position, it's a chance that I go wrong are pretty high. Instead, on the high frequency side, I tend to avoid all kind of biasing. Think that it's very difficult to do with a position because, for example, right now, if you ask me, is the stock market going to go up or down? I would think down because of all that has been going on in the world with the coronavirus thing and everything. It's pandemic, so of course, I'm going to bias myself thinking the market is going to go down. And it kind of did go down, but then it's pushing back up all the way. So it's kind of weird. If you ask me on a perception kind of point of view, on the intraday, on the high frequency side, I cannot bias myself because, you know, I could be long now and in 5 minutes I could be short. So I get all of the market. If it's going up, if there's volume to the upside, I'm long. If there's volume to the downside, I'm short. So I'm pretty quick to change my mind. And again, there's no bias effect.
Right.
But to finish the answer to your question, yes, I do it fully manually. I just rely on what I see on the screen from my algorithms, and I follow the algorithms. But then when I want to turn down the operation, I turn it down. And when I want to restart, I restart. Instead, an algorithm would be pumping trades over and over.
That's very interesting. I have a lot more questions for you after this break that we have. For those watching, this is the 161 report, and what you're about to see is actually the 161 group was featured on local news yesterday, and we're very, very excited about this. We just launched our incubator that is going to be officially starting Monday, June 8th, and we're very, very pumped. The application is now live. It's open until June 6th. That's next Friday. So for those watching, please share that with anybody. And I hope you enjoy this feature that we had in the news. Thank you.
Business at any time can be stressful, even more so during a pandemic. TV20's Claudia Bellafato tells us why entrepreneurs in Gainesville say if you're in the area, you're in luck in this week's Tech Tuesday.
We saw a need and just kind of filled it.
Well, it wasn't quite that simple.
So when we first started it, it was really just, it was a couple of students and our mentor.
161 is an organization created to help entrepreneurs and startups connect with the resources they need to grow, a process that the co-founders know well from experience.
Little by little, so we started adding in more successful entrepreneurs, more investors, and now our organization, we've got a really big network of venture capitalists, investors, entrepreneurs, speakers, mentors, industry experts.
161 would typically hold in-person workshops or roundtable sessions at spots like the UF Innovation Hub. But since the pandemic started, they've had to take even those, you guessed it, virtual.
And we decided, okay, we can't do any more in-person events, and we can't control that. So let's just use our time to create value for our members, for our companies, for our network in the meantime. And we launched the show called the 161 Report immediately.
The 161 Report is the platform they use to put on virtual events that they can no longer hold in person. But virtual or not, the company takes pride in its home base.
There's some of the best talent in the world here at UF, and companies like Google, Facebook, LinkedIn, they're all coming to Gainesville to be able to recruit from UF, and some of the talent here, some of the best programs in the world, some of the smartest and brightest and forward thinking.
And the criteria for joining the group is simple.
It's not so much we're looking for you to have an idea like Airbnb or an idea like Uber. We're looking for people who are going to build something, and even if their first idea fails, even if their third idea fails, maybe their fifth or sixth idea will succeed.
So from a couple of young entrepreneurs to the next.
If you want to go fast, go alone, but if you want to go far, go together.
Claudia Bellafato, TV 20 News.
Welcome back to the 161 Report. We're here with Alex Lualdi, and he was here just telling us about how he creates a systematic approach to create trading models that he actually uses. And it's a very fascinating thing because, you've got a lot of people out here who are trying to make money making trades, and they don't have algorithms. They don't have these tools. And so they're kind of screwed if they're not using one of these, because you've got the top traders who are using them, right? And so my question to you, Alex, is if you were to give somebody who has very little trading experience access to your tool, do you believe they would make money with it, or what are your thoughts on that?
It takes a while to get used to the approach, meaning you go from zero or from a different approach to having to take trades, tons of trades every day. The good thing is that you can also apply to long term. I don't do it, or I do it not that often because it's so much profitable, the AI frequency, that I tend to just do that. But I have clients and investors that use the software and the approach to trade long term, and they're doing pretty well. So it depends on the experience of the person starting. I want to say that we put a lot of training hours into each and every client, and that's the only secret that's behind it. I mean, once you see the software, once you see how we use it, you understand that it's possible to make money, then the training that is required is not really on the system sorry, or on the strategy itself. It's more on another side of the trading, which is tougher. It's more important. Is delicate. Is really the one that takes more to develop, which is yourself as a trader. And this is the real secret, I think, that I learned, that yes, you can have a great system, and you can have actually a system that is magic in some cases, because it shows you everything, the volumes, and exactly which price to buy at. What could you ask for more? But then it comes down to the psychology of the trader, right? So I put a lot of time and effort in trying to develop the mindset and the skills that every individual trader must have. I'll give you an example. I have a trader that has been trading with me for 4 years now, and that I trust a lot, and that did really well on a smaller account. And finally, I decided to give him part of my capital to trade on a broker here in London. And I did pretty well for a few months. And then in one day, unfortunately for me, he lost all of the money that I had given him to trade in one day. So this to tell you that the system is very important. The training that we do is also very important, because without the training, you could not you could not trade, because you have things in front of you that you don't understand. It's numbers, and it's you see the volumes again, but you have to read them, and you see the price, and you have to know exactly what to do when the price is reached. And but that's the easy part. Then the tough part is, again, entering the mind of every individual trader and understanding, does he have a gambling kind of mentality? And we need to eradicate that. Or does he have fear? And we need to eradicate that. In my case, if I have to talk about myself, for example, I'm more of the second kind. So I've always been more of the second kind. So if I have one of the two problems, or problems, let's call them, between greed and fear, I have more the fear side of it. Okay, so there are other people which problem is greed, is that they are too speculative, they are too aggressive, they are too much risk takers. In my instead, fear has blocked me many times to make the best out of the market, to get the best opportunities, and to let the trades run a little bit more than I did. And that is a problem. But I realized over the years that, since we're talking about secrets, that this is the secret. So eradicating the greed side, that doesn't have to be there at all. So greed is a problem. So when in the movie Wall Street, Michael Douglas said, greed is good, well, I beg to differ. Greed, in terms of trading, is bad, is one of the worst things that you could add to your trading plan. Fear can be a problem, but can also be a savior, can also be the thing that keeps you with your feet on the ground, that keeps you from risking too much, that keeps you from taking that trade that went wrong, taking it again, double the size, and stuff like that, right? So you need a little bit of fear with you when you, because
one of my favorite quotes about investing, and this ties in with what you were just saying, fear and greed, is by Warren Buffett, and he says, to be fearful when others are greedy and be greedy when others are fearful. What are your thoughts on that quote, and is that something that you apply, or what are your thoughts on that?
Pablo, I agree with anything that Warren Buffett says. I couldn't disagree with him. I mean, all of the quotes that I read are spotless. I mean, this guy is such a brilliant investor and person that, every time he opens his mouth, he's saying something that goes straight to the point. And this is one that I like, the one that you mentioned. But my favorite is about diversification, and it says diversification is protection against ignorance. It makes little sense if you know what you're doing, and this has been my favorite quote of Warren Buffett, and I've always developed my own career based on this, actually, because I really believe in it. I believe that diversification in finance is a word used too much. It is not only a word used too much, but it's a strategy used too much. What do you need diversification for? When you know exactly what you're doing, when you know exactly what you need to buy and what you need to sell. Because diversification, what it's going to do is going to hedge a little bit the risk, but it's going to hedge also on the other side. So it's going to take away part of the risk, but it's also going to take away part of the potential returns. Correct. So when you go and talk to an institutional person and is using the word diversification at least 3 times, that means that he's a little bit confused about what to do in the market. If you talk too much about diversification, it means that, okay, we're going to buy this, that, and the other, and we're going to put them together, and hopefully they're going to produce 2% at the end of the year. And it's not my approach to trading in particular. It's not my approach to life in general. So if you got to go and do something, you have, first of all, to know how to do it. And second of all, you have to make a decision. You cannot be putting all things together, hoping that one is going to offset the risk of the other one. And because again, it's going to offset also the potential side of it. So what you want to do is really know what you're doing and take a clear decision. If you think that your system is telling you that you got to go long on the S&P 500 right now at this price, then you're going to go long on the S&P 500 at this price. And that's your play. So you're going to have to take a play. The play is good, you're going to make money. The play is bad, you're going to lose money. That is trading to me. And it's a different vision than most people out there. But then again, I don't need to sell a product, okay? Unless we're talking about my software, but that's different. But when it comes to finance, I'm not an institutional person. I don't have an institutional approach, and I don't need to use words like diversification or words like that in order for me to be able to make the customer feel safe. There is nothing safe about the financial markets. They're very tough to play with. They're a very tough job as well. So knowing that every decision that you're going to make, is a decision that has 2 options. One is positive, one is negative. Unfortunately, there is not much that you can do. There are some strategies that have almost a 100% winning ratio, but those strategies are sitting in a bank, and the bank is trading those strategies with their own money.
Right. We're going to have one more question here before we go into our last break of the show. And so we spoke about Warren Buffett a little bit and his philosophy. Another investor that I really look up to, even though I'm not super educated in the investment world, his name is Ray Dalio. I'm sure you might be familiar. I know that he talks a lot about diversification, and I know that his approach to trading is very different from what you do. What are your thoughts on the comparison of these two? I know, like, for example, I think the average returns that they've brought in maybe somewhere around like 15-20% per year, but they've only lost money 1 year, I think, in the past 30, 40 years, which is quite impressive. I think 30 years. So what are your thoughts on an approach like that versus an approach such as what you're doing?
It's very difficult to say because I'm not familiar with what they're doing. Meaning, I know what they say. I read what they say, and I listen to the interviews. In particular, Ray Dalio, who speaks a lot about his job and about what he's doing and about the markets in general. But I'm not familiar with what they're doing to make money as actual trades. I know the approach of Warren Buffett is a little bit more comprehensible because his trades are in companies that he owns for a very long time. So he buys Coca-Cola in, I don't know, I think in the 80s, and he holds it forever. And I know that's a buy and hold strategy, but his ability is to not only read the market and the market cycles, which is a great thing, but he also knows how a company functions, and he can go to visit the company, read all the important financials about the company, and understand, is this a company that I want to buy because it's going to create value, it's going to have value over the years, it's going to generate the value for Berkshire. And that's, something that he can do because his brain is like a computer, is analyzing data in a way that nobody else does. And to apply that strategy, you really need to be super smart. I don't know about Ray Dalio. I'm really not familiar with his approach, with his strategy, and it's not as transparent as a strategy to me as Warren Buffett's. So I couldn't judge. The difference between Warren Buffett's and my approach is that, again, he's super smart, so he doesn't need a system, a quantitative system to help him. I'm not super smart like him, so I need a super smart quantitative system for me to know exactly what to do.
Right. That is a good insight right there. Warren Buffett is definitely, he's not human, I don't think. He must be an alien because what he does is kind of crazy, and the fact that he's 89 and still at it, reading, a book every 2 days or whatever it is, it's insane. So we've got our last commercial break here, and I'm very excited to continue this conversation. This is actually fascinating. So our last message of the day for the show is from Synapse, Florida. They're actually having their first virtual conference called Converge. So we'll be right back after this message from Synapse.
Hi, I'm Lauren Prager.
Hi, I'm Allie.
Hi, I'm Kylie.
Hi, I'm Monica Angel.
Hi, I'm Brian Kornfeld from Synapse, Florida, and I'm amped to announce the next evolution in supporting Florida's innovation communities.
We're living in a time of unprecedented challenges and opportunity, but crisis fuels innovation, and Florida's talent is stepping up to meet the moment.
Innovation requires collaboration, and Synapse exists to foster meaningful connections.
We're here to help you find what you need and share what you have.
What better way to foster this camaraderie than through a digital, statewide meeting of the minds?
A rally.
A convergence.
Synapse Converge is an interactive digital conference unlike any other you'll be invited to this year.
It's for innovators, created by innovators. This is not your typical Zoom meeting.
This is a time for hands-on learning, meaningful connections, intentional engagement, access to the experts you need in order to succeed through live chats and Q&A.
And For those of us still working at home with our colleagues,
Kids or dogs. If they pop in, you've got all the sessions and they'll be recorded and available to watch anytime during the conference.
So mark your calendar.
No, really. Click below to register.
June 9th, 10th, and 11th.
we'll see you there.
Welcome back to the 161 Report. We're here with Alex Lualdi, and he was just telling us about the systematic approach that he takes to trading, as well as comparing and contrasting different styles of trading. One question that I've really wanted to ask you is, I've heard a lot spoken about the importance of keeping emotions out of trading, and I believe this is why you mentioned it's so important to have a systematic approach. Potentially to keep the emotions out of it. Is that why? And what are your thoughts on that concept?
And it's a real secret. So this is the real secret. And I'm happy that you asked me this question because it's a very tough one in trading and investing in general. As I mentioned before, when we do training with a trader that either needs to work for me or it's an external trader that purchases the software and gets trained, we work a lot on the training side in terms of technique, but we also work a lot on the psychology side. So we try to actually understand person by person how he reacts in front of a loss, in front of a win, which is also important to see how one reacts in front of a win. And we try to understand how he works under pressure, because it's very important in trading to control your emotions. For me, it was important in particular to have a systematic approach, a process-driven trading approach, because I tend to have, or I used to have problems managing my own expectations towards the trades, and in particular reacting to losses or even to profits. Used to get very excited about a profit. Now I don't anymore. So that's one thing that tells me that I grew as a trader over the years, that I'm a better trader, because when you get too excited about a win, is the minute that you're ready for a loss. So now I keep my emotions more in control. But I think that part of it was due to the fact that the systematic approach taught me to take, first of all, many trades, and second of all, spread the emotions through these many trades. And when also you are relying on a machine or an algorithm to take decisions, there is something very important. You're not going to, when you take a loss, you're not going to take it as personal as you would take a loss if you're trying to guess the market. So if I'm guessing the market and I'm saying, okay, I think that S&P 500 is going to go all the way down, and S&P 500 goes all the way up, personally, of course, I'm going to think, okay, I screwed up. I was wrong. If I'm following an algorithm, I'm following a system, and the system is telling me long, now market goes against the trade and I take a loss, I'm going to take it on the machine. I'm going to say, hey, the algo took a loss. It wasn't me. So that's very important, because even if you don't realize all this spot process, of course, it's irrational. Still, it's there, and still is going to help you feel better and take the next trade with different kind of mindset. That is very important.
Right. So we're now in the last 10 minutes of the show, and one thing that you had brought up to me when we were talking the other day that I've actually really been wanting to ask you about as well is, you said that you were in talks with a venture capital firm about potentially investing in your platform, in your company. Is this something you're allowed to talk about? And if so, then can you share some more information about this?
Absolutely. Absolutely, no problem. Yes, I talk about it with no problems because, first of all, I'm talking to a few venture capitals. With two of them, we are already in advanced talks. And the project is to take the software and bring it to the next level. The project should be completed by next year. And by project, I mean, the first phase one, which is prototyping the software. And they should be going to market, if everything goes well, with one of the venture capitals, which it should, by January, 2021. And we have great expectations because the software, again, is, first of all, not going to compete with the major players, but it's going to integrate with them. So that is the approach that we're going to take. We don't want to compete, of course, with names that have been in the industry for many years, in an industry that has $30 billion a year in revenues. But we want to actually try and develop a very niche quantitative software, and then again, integrate it in the other platforms that are currently on the market. And the project is also going to include the creation of trading rooms, in particular in London, New York, and Miami to start. And it's going to be very interesting because we're going to have dedicated desks for traders that are going to be able to use the software and also get trained on a daily basis. So there's going to be a trainer in each trading room that is going to help traders achieve their own goals. And hopefully the project is going to go well, and we're going to sign a contract soon with a venture capital, and we're going to have all the funds that we need in order to invest in marketing and invest in the prototype and invest in all the phase one investment requirements, which are a lot, as you can imagine, especially in a field where, if I were to do it myself, first of all, I would have to put out a lot of capital, but it's not only that, is that I have limited resources of time and energies and limited capabilities. So going with a venture capital is going to allow me not only to have more capital, but it's going to allow me more resources, more energies, and more capabilities.
And if things go according to plan, where do you see yourself 5-10 years from now? Do you see yourself running a multinational trading algorithm company that has offices in all these places, New York, Miami, Europe, China, and you have employees all over the world? Is that what you see, or what is your vision for this?
When you do something like this, in particular, when you go and talk to venture capitalists, you have to dream big and to show a big plan. But to be honest, the plan is big not because of that, but it's big because of the potential that we have. The market timing value of the systems of my models, in particular the one that is called the formula, it's huge. I mean, it's a potential that I cannot even start to describe. To take it to the market, to the public, through a prop software, and go around and show it to institutional people and to bankers and to such a broad market, family offices, and all the asset managers. Such a big market. It's going to be interesting to see what happens, but you must dream big. And of course, I chose London because I currently live in London. New York, where is my favorite playground, and Miami, which is my second home, because also there's a lot of hedge funds and big players in these three cities.
Right. When your company blows up, make sure you remember us little people.
Well, we're gonna be talking together for a long time. I hope, Pablo. I hope that you invite me again, and if my business grows, I'm gonna be super happy to come back and tell you everything about it.
Yeah, we'd love to hear it. So we're wrapping up here, but is there any lessons that you've learned in your career that you want to just leave our viewers with, or any last minute remarks, any thoughts on where they can learn more about you and your platform, anything at all?
Well, they're free to talk to me anytime. They can contact me on the website, hudsmet.com, hudsmet.com. And I talk about trading all of the times. I have these great passions for it. So for me, not only on a sales perspective, but even to just talk with them is a great pleasure. If they have any question, and they can contact me again. We have fearless.money now that is going pretty well, and we have a lot of contacts from this page, which is a program for those who want to learn high frequency. Fearless because you need a lot of energy to be trading high frequency, and you need not to be scared by the markets if you want to be trading high frequency. And again, it's a pleasure to talk to investors for me, and to talk to new or more experienced investors. It's what I do every day. So again, if you can put a link of the website, that would be great, and they can contact me from there.
Absolutely. Well, Alex, it's been a pleasure. Thank you so much.
Thank you, Pablo, for having me. It was great. Thank you.
For our viewers, this is the 161 Report. Thank you so much for tuning in. We've just got some last minute couple of announcements that we want to make. Again, the 161 group was featured on local news, ABC's WCJB TV 20, about our incubator that just launched. Remember that applications are only open until Friday, June 6th, and we're only going to be selecting 5 companies, but the companies that we're choosing, it's not so much about who's the best idea or how far along are you. What we're really looking for is people that have proven themselves to be able to build things in the past, whether it's a company or just a cool side project. We're really looking for founders that are ambitious and inspired. So take a look on the website, 161group.com, hit the application form, and learn more there. We've got a blog post with all the information and some FAQs there. To our viewers, thank you so much for tuning in. We've got a real big treat for you guys this summer. We've got some really big, awesome speakers lined up for the whole summer, and we're very excited to share that with you guys. Thank you so much. It's been my pleasure. This is the 161 Report, streaming to you live from Bamboo Strategic Media.